Thursday, July 1st, 2021, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at inflation, how central bankers now are warning that it's not transitory anymore. And if you've been listening to me for the last few months, you will know that I never bought into the transitory agenda or mantra because as most of you know by now, hopefully inflation is not the CPI, it's not the PCE. That's the consequence of inflation. Inflation, of course, is the excessive creation of money and credit. And that's continuing. It's not stopping. We've seen how M1, M2, the Fed's balance sheet, the ECB balance sheet, the Bank of England balance sheet, they're all going through the roof. And they're not going to stop, because if they stop, if they even try to slow down or even think about raising rates very soon, everything will implode. So they have to keep going. The problem for them now is that through the Cantillon effect, this inflation is flowing very quickly into commodities and consumer goods, into services. They can't hide it anymore. It's not that it wasn't flowing into those parts of the economy in the past 10, 20 years. It's just that they were able to tinker with the statistics. Now it's getting very difficult. Now it's approaching 4 or 5%, even through their doctored statistics. Of course, if they calculated it like they used to do in the past, like in the 80s or 90s, it would be more like 10 or 12% the real rate of price increases. But as you can see here from the FT yesterday, Bank of England's Andy Haldane warns over inflation complacency in parting shot. Interesting that it's a parting shot. It's because he's leaving as the chief economist. So he's warning now here. He says, Haldane said he expects inflation to be close to 4%, double the BOE's target by Christmas. Well, I'm not surprised. And of course, they use the term incorrectly there. He should say he expects CPI to be close to 4%, because the inflation is going to keep raging. And most people won't realize that. But I don't think they're going to raise rates or even think about tapering their QE, because in the past, I remember the CPI being around 5% and they did nothing to rates. The only time they really come out and do something to rates in an emergency and aggressively is when they cut rates. When they have to rein in the inflation, they always drag their feet. And with that, I'm going to show you what I mean. Well, even economists here from this FT survey, they are predicting rate hikes now by the end of 23, but they're only predicting rates to be around 0.5% or 0.75%. So even if we get to 0.5% or 0.75%, that's very near zero. Even if their measure of inflation, PCE or CPI, gets back down to 2.5% or 2%, real interest rates will still be negative, and your savings are going to still be ripped out or confiscated from under you through negative rates. So I don't think things are going to improve. So it says here, the FT IGM US Macroeconomist Survey polled 52 academic economists on the likelihood that the Fed's main policy rate would indeed be higher by 0.5 percentage points by the end of 23. As the dot plot indicated, a majority said the likelihood of a move of that size was greater than 75%. And a large minority put it as high as 90%. So it's not even like it's going to be at 3 or 4%, which is where it really should be if they want to neutralize the CPI, which could drop to 2 or 3%. Right now, we're more like 4 or 5. So what I'm trying to tell you here, yes, they're going to come out and scare precious metals investors, people who are in hard assets, that they're going to fight inflation, that they're going to raise rates by the end of 2023. But it's going to be insignificant in relationship to the rate of increase in prices. And I still don't understand, or maybe I do because they're forced to through regulations, why fund managers, pension fund managers who run hundreds of billions or trillions of dollars of people who are going to retire in 5, 10, 15 years time, why they put their money into bonds just boggles my mind, especially with what's going on. They're not going to do anything about inflation, guys, even if they keep coming out and with their federal open mouth policy of sending all the Fed officials out, the Bank of England officials out. But you note that Mr. Haldane is actually leaving his post, so he wants to cover himself because I think he knows things are not going to get better in terms of the loss of purchasing power of all fiat currencies. So with that, let's quickly look at where the markets are this morning. It's 8:30 a.m. London time. We've got spot gold at $1777.50. That's up just over $7. The high has been $17.79 and the low $17.65. Silver is actually doing fairly well this morning. It's up 2/3% at 26.27. I think there's a couple of key levels here for silver in the short term. 26.30, which has been basically the high overnight. High has been 26.32 and the low 26.02. And after that 26.30, I think 26.50, if silver is able to break out of those two levels, it could be quite positive. The other positive thing that we're seeing is that the mining stocks yesterday did quite well, despite the fact that the dollar was quite strong. So who knows? Are we near a short-term bottom in precious metals? We'll have to wait and see and be patient. We've got the Dow future up 136. We've got the NASDAQ 100 future up 22. We've got the S&P future up 1/3% or 13 points. The currencies, we've got sterling unchanged at 138.30. We've got the euro unchanged at 118.50. We've got the dollar up slightly versus the yen at 111.22. We've got the dollar down 0.1% versus the Chinese yuan at 6.46. And the Aussie dollar is at 75.03. It's slightly lower than yesterday. I think we were around 75.15. WTI crude is up 0.75% at 73.72. High grade copper is unchanged at 428.50. The 10-year yield is at 147, so up about 3 basis points. We saw some data yesterday. The Chicago Purchasing Managers Index came down quite a bit. It was a lot lower than expected as well. Came down from the previous month. We saw housing starts also drop quite a bit. So I don't think the US economy or the UK economy are going to get better anytime soon, or the EU economy that depends a lot on tourism coming from the UK. I think a lot of the European Mediterranean countries are going to get hurt because the British go a lot on holiday over there, and right now things are very uncertain. So we're going to continue to see inflation, and by that I mean money and credit being made abundant. That's going to continue to lead to higher prices. Of course, we've got the supply chain problem that's creating shortages all around. That's going to also put pressure on prices. We've got talk in the US. I've heard from viewers that there's water shortages in the west of the US. that crops are going to fail. So yeah, things don't look great. We just need to keep our heads down, try to weather the storm. That's all I can say. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.